Hi folks, welcome back to Meaningful Money. Okay, here I am with the backdrop of Newlyn Harbour, all the boats looking very pretty. We're going to talk today about drawdown, or more correctly called unsecured pension. We've been talking about annuities. We had a little gap for Justin Urquhart Stewart last time, but we've been talking about annuities, and you know now that when you buy an annuity to get your retirement income, you hand over your fund once and for all in return for a guaranteed, secured income from an insurance company, an annuity provider. The problem with that, as we've discussed, is that you hand your fund over and it's gone, which means you're taking the ultimate risk of all, which is mortality risk. How long are you going to live? Are you going to get the benefit of all that money that you've handed over to them? Are you going to get the benefit back in income? All depends on how long you live and what options you choose. So necessity is ever the mother of invention, and somebody eventually thought that that wasn't a brilliant idea, handing over your money for an annuity. So they came up, no idea who, roughly 20-25 years ago, with the idea of unsecured pension, but traditionally called drawdown. And under drawdown, you keep your fund and effectively tap off it every month, an income that goes into your bank account. So it's like going to the cash machine, effectively, and drawing your money from your pension every month. That income is taxed, just like an annuity is, but that's essentially how it works. You keep your fund and you draw off it. Now, how much income you can get depends on various things, just like it does under an annuity. It depends on your age and your gender, and it depends on the size of the fund you've got, and it depends on things called gilt yields, which we talked about briefly in under annuities, and something called the Government Actuary Department limit, or the GAD limit. Now, what the GAD do, the Government Actuaries Department, is they do some sums, and they look at the gilt yield, current gilt yield, and they look at the age and gender and do some calculations as to how long somebody might live. And the idea of the GAD is that it's meant to roughly reflect a single life annuity, roughly, okay? So, here's an example. If you are a 60-year-old male, currently the GAD limit is £57 of income for every £1,000 of pension fund. £57 of income for every £1,000 of pension fund. So that's a 5.7% GAD rate. Okay. Now, sounds like there's a silly helicopter going overhead, so hopefully you can hear me with the newfangled tie mic. So let's use a real example then. And the first thing to mention, actually, before I do that, is that there's a link under this video to the Government Actuary Department website. Nearly gone. Which will provide a link to the tables, which are in Excel format, so you should be able to open those and just see. So £57 per £1,000 of fund. So let's imagine you're a male age 60, you've taken your tax-free cash, because you can still do that under drawdown, and you've got a £100,000 fund. As ever, I'm making the mental arithmetic easy. So if you've got a £100,000 fund, you're a male age 60, the GAD limit is £57 per £1,000, which means an income of £5,700. Except that it doesn't, because what the rules say is that you can have a maximum income of 120% of GAD. So if GAD is £5,700, 120% of that is £6,840. So now you have your minimum and maximum. Now you have your minimum and maximum. Your minimum income you can take from a drawdown is zero. You don't have to take any income if you want. And that can be useful for financial planning. We use that with our clients quite a lot. The minimum is zero. The maximum in this example then is £6,840. So that's essentially it. You keep your fund and you draw off it. But there's some considerations. First thing to say is that which is a plus on the plus side, is that the death benefits are of use in drawdown. We've said that with annuities you don't effectively get any death benefits. You hand over your fund and it's gone. But with drawdown you keep your fund. Now let's say, same example, I'm a male age 60 and my wife is a female age 60. Right? Now if I die first, she has a choice. She can either continue into drawdown, but with it all recalculated by the fact that she's female, or she can take my pot as a lump sum. But if she does that, she will pay a special rate of income tax of 35% on it. But even so, she's going to get 65% of my fund to do with as she wants. Buy a cruise, pay for the marriage to her new husband once she's forgotten about me. But she can do what she wants, and at least she's got 65% of my fund rather than 0 as she would have got under an annuity. So death benefits are a good thing under Drawdown. Here's some other things to consider though. When you buy an annuity, you benefit from something called cross-subsidy, which means that if you live a very long time and the annuity pays out to you for a very long time, you are being subsidised by those who die early. And the actuaries at the insurance companies do all sorts of complex maths to work out what rate they give you for an annuity, which takes that into account, this cross-subsidy between those who die early and those who die late, live a long time. When you go into Drawdown, you are essentially deferring annuity purchase, so you don't benefit from that cross-subsidy. And all that means in practical terms is that your fund in Drawdown needs to grow that little bit more to take into account of you not having the benefit of that cross-subsidy. It's also got to grow a little bit more because there are charges involved with Drawdown. Your money is invested, so wherever it's invested, whatever fund or whatever, there'll be charges on that. There are charges for the administration of a Drawdown, and all these things need to be taken into account. And there is investment risk as well, because your fund remains invested. So all the usual stuff about risk and risk management apply, spreading the money around and things like that, keeping it under regular review. All that means that Drawdown essentially, usually anyway, is for people with decent sized pension funds. Now it depends on the individual circumstances. I have done a Drawdown for just over £30,000 pension funds, but that is very unusual. More often than not, it's funds above 100,000. Everybody's different, every case is different, but the costs involved in keeping the money invested, the costs involved in counteracting that mortality drag, that loss of cross-subsidy, all add up. And so you need a decent-sized fund, really, to justify those costs. That's basically it, all right? A lot of information there. But leave any questions in the comments as usual. Next, we're going to go into talk about phased retirement, or something called also called staggered vesting. Phased retirement is a way of sort of staggering going into Drawdown over time, and it's the deep end of the pool when it comes to complexity, but I'm hopefully going to be able to explain it to you in a way which makes sense. There'll probably be lots of graphics on that one though. So thank you very much for watching, and goodbye from Newlyn Harbour.